Okay. All right. Good afternoon. My name is Julia Barron, and I've been with Arthur J. Gallagher Risk Services as a PNC account executive for more than 5 years, and I am a proud member of TMA Detroit. I'm delighted to present 3 incredibly well-qualified women in the insurance industry to talk about commercial insurance and how it impacts business enterprises in distress. But before I get started, I'd like to thank and identify our generous sponsors, which include BDO, Bridge Business Credit, and Pathward as our gold sponsors. Our silver sponsors include Alex Partners, Capstone Partners, A&M, AMG, Bank of Ann Arbor, Doran Mayhew, DHW, First Business Bank, Taft, Kerr Russell, McDonald Hopkins, Miller Canfield, Morris Anderson, Newpoint, Plunkett Cooney, Riveron, Schaefer and Weiner, Spectrum, Tab Bank, Troutman Pepper, Varnum, and Warner. And finally, our bronze sponsors include Dickinson Wright, LJE Law, Getzler Heinrich, O'Keefe, and Strobel. And you can register for all of our events on our website, which is turnaround.org/Detroit. So the framework for this webinar is to be a very brief overview of insurance for distressed business, which is why we're all part of TMA Detroit and why we're all here today. And distress can be related to a wind down or a sale or an acquisition of a business. It is a pull on a company's resources, both people-wise and financially. Internal and external parties are focused on how a business will emerge from a distressed situation, and there will be Monday morning quarterbacking. So the management of a properly insured business will have a better chance to come out of these situations and will have improved opportunities to fight another day, whatever that may look like. The insurance topics are very broad, but I wanted to give everyone on the call or this webinar a chance to think about some better ways to protect your clients, debtors and creditors, buyers and sellers, as you move through relatively fraught circumstances. And the specific insurance areas that we're going to talk about today will be management liability, risk control, and reps and warranties, which is how to get the deal done. So with that, I'm going to start by introducing our panelists. I'm going to start with Miranda Despain. She's with Gallagher. She's a senior vice president in Gallagher's management liability practice. She has specifically focused on client development and advisory for directors and officers liability, employment practices liability, and related lines of coverage for complex publicly traded and privately held organizations. Her strengths and expertise include her strong market relationships, experience with manuscript policy forms, transactional due diligence and program design, and international risk analysis. She has spoken on numerous panels about market negotiation strategy, as well as public securities exposures and trends. Miranda is approaching 18 years of experience in management liability insurance brokerage and strategic consulting. She graduated from the University of Illinois at Urbana-Champaign with a Bachelor of Science in Finance. Our next panelist, Ann Parkin, she has been an industry lead with Sigma 7, which is a global risk consulting advisory firm. She has over 25 years of experience working with property risk consulting for large global clients. She started her career at FM Global as a field engineer and then moved on to Aon, where she worked for the Global Risk Consulting Group, providing advice on how to lower their total cost of risk. She recently moved to Sigma 7, which is a startup consulting firm that is the largest independent global risk advisory firm to help companies with all their property and related risk consulting concerns. And Julia Papastavridis is a managing director at Aon's M&A and Transaction Solutions, including reps and warranties. She is based in New York, where she leads the New York practice group for representations and warranties insurance. Julia is an experienced corporate attorney and M&A broker with a demonstrated history of work in transactional risk in the insurance industry. Before joining Aon, Julia was a senior transactional risk broker at another major brokerage firm in New York City. Julia also brings extensive experience to Aon from her prior positions as a representations and warranties insurance underwriter for AIG and at Everest. Before joining the insurance industry, Julia was a corporate M&A associate at the law firms of Kramer Levin and Dentons in New York City. Julia earned her JD from the University of Michigan Law School, Go Blue, and her MBA from the Institute of Business Administration in Lyon, France. So with that, basically what I've asked our panelists to do for this call is to focus on their specialties and tell us the story. Tell us what happened, tell us what went wrong, and finally, what do you tell your clients in order to minimize these particular challenges? And as we go through, please, please, please feel free to post questions in the chat, and we will do our best to respond. And with that, Miranda, would you please tell us your story?
Thank you, Julia. So I know, while many of you are attorneys, I must disclose that I am not one. So anything I say cannot be construed as legal advice, even though my name is Miranda. I am a management liability broker that focuses as an ally with clients who are navigating unforeseen, or in the case of a distressed business, possibly foreseen financial risks associated with directors and officers liability. So as Julia said, I'm going to walk through a story, what happened, what went wrong, and then touch on a few different claim sources associated with distressed businesses and bankruptcy, and then finally get a little bit more into the insurance piece and how it all ties together. So what happened? 2023, I think many have said, is the year of the bankruptcy. And that is no exception for our portfolio of clients. We've seen a number of very high profile bankruptcies this year. And, when we're talking about these, a distressed client, the story I'm going to tell, this client was, I will say, is my best friend. Like we were very tight, a trusted advisor. And in these scenarios, insurance can either be front of mind, back of mind, or out of their mind, right? So sometimes we're involved from the beginning. And other times we're not involved until the very end. So the story I'm going to tell, the good thing, what didn't go wrong, is that I was involved with them every step of the way, was able to counsel them as they approached a myriad of risks and potential avenues to sell or to stay afloat, essentially. So I had a distressed client that throughout 2020 and 2021 attempted an IPO, failed, attempted a de-SPAC, failed, numerous attempts to sell the company, did not come through, partially arranged a 363 sale in lieu of a Chapter 7, Chapter 11 scenario. That didn't work out either. Ultimately filed for Chapter 11 bankruptcy after a long road of stops and starts, potential avenues to stay viable. And what went wrong in this scenario? I mean, obviously I wasn't behind all of the closed doors, but I think, oh no, my lights just went off in my office. Investors and potential buyers could never come to an agreement on valuation. So there's always a valuation issue. At one point, the company was worth $5 billion. At another point, the company was worth $500 million. It was a fudge factor in the actual valuation of this privately held organization. And what really compounded that was that the company itself was never actually profitable. It was never making money. They were very optimistic and aspirational and told a great story, great people, great management team, but just really never got it together. There was a lot of headline risk associated with this too. So when we're talking about in the context of directors and officers insurance, or D&O, the underwriters were reading the gossip, right? So no matter what messaging we were trying to provide in tandem with my client on what was going on, there was also the side piece of all of the industry rags telling their story for them, whether it was true or not. So that was a very challenging factor when trying to work through many of these stops and starts. Another factor that influenced their D&O insurance was that their program was drastically impacted by COVID and never fully recovered from a premium and program structure standpoint. So they had excessive self-insured retentions or deductibles, excessive premiums, exclusionary language that was atypical, and really we had not much flexibility in this environment to make changes prior to them filing for bankruptcy. So we were essentially stuck with a legacy program that was wildly expensive and not terribly valuable, and trying to figure out how to build out something that would protect them in a bankruptcy scenario. So in a bankruptcy scenario, I'm often asked about claim sources. So obviously, I mean, and I'm sure I'm preaching to the choir here. Claims by creditors, fraudulent conveyance prior to bankruptcy, disparate interest, right? Various levels of funding, debt, equity, those with board seats who may be driving a company into bankruptcy, where do their interests truly lie? However, from a insurance broker's perspective, I really don't see a terribly high frequency of claim, in the scenarios where the fifth venture capital firm has bought the debt for pennies on the dollar, right? So in that environment, that's purely a speculative investor. So they really don't have the concern, the skin in the game, the cause to bring litigation in the event of a bankruptcy, at least in my scenario. So from there, I'll take a quick breath, and then I'll move over into how we teach our clients on how to minimize challenges associated with D&O. And Julia, if there are any questions that pop up, let me know. I don't know if I can see anything, but let me know. So D&O coverage implications. There are 5 key areas that we focus on in a D&O policy. And I should back up one step. The key for a bankruptcy scenario is that we eventually place a D&O policy into runoff or a tail or an extended reporting period. They're all semi-exchangeable words that essentially means at some point we stop providing coverage for go-forward acts and we put a policy in place to contain all past liabilities associated with the bankruptcy. So in doing that, we want to make sure that the policy is designed to respond when there's no money left in the corporate coffers, when there is a debtor in possession, when there's trustee assigned, and we want to be very cognizant of the unique exposures associated with a company in bankruptcy amidst the bankruptcy process. So first, the definition of insured. This is a simple one, relatively standard. The insured should always include the debtor in possession. This is fairly standard on most D&O policies. On occasion, I've seen that the trustee itself requires an endorsement, naming them as an insured under the policy as well. They don't have rights to, say, cancel the policy or make amendments to the policy, but they are considered an insured under the policy as well. That's something that we dealt with in this scenario. The second, the insured versus insured exclusion. And this is another standard exclusion in a D&O policy. We want to carve out for coverage for claims by trustee creditors committee on behalf of the debtor against the directors and officers. And ideally, even better, while in financial impairment. So we want to make sure that those types of claims aren't kicked out and deemed insured versus insured scenarios that are not covered under a D&O policy. The third is waiver of stay. So parties agree to waive any automatic stay that may apply to the recovery of D&O policy proceeds. This is specific to the entity, not the directors or officers, because the most critical coverage, the side A portion of a D&O policy, that's non-indemnifiable coverage for individual directors or officers, that is not considered a violation of automatic stay. So we want to make sure that that policy language is trued up and appropriate to ensure that the bankruptcy court doesn't try to seize the assets of the D&O policy. Fourth, priority of payment. This is another standard part of a D&O policy, but it becomes very important in this scenario. We want the policy to respond to individuals first, not the entity. We don't care about the entity. We want to make sure that the individual directors or officers have first dibs on any policy proceeds in the event of litigation. Then second to that would be the company itself. And finally, the biggest issue is the change of control. So harkening back to the runoff piece, when do we put this runoff in place? A company's in bankruptcy. What do? There's a few, and it varies, right? So old policy, policy forms may have said, this policy has triggered a change in control upon filing of bankruptcy. And what does that mean to our client? That means the moment they file for bankruptcy, they no longer have D&O coverage. That's a terrible thing. This is when they need it most, right? So we have many manuscript crafted languages to ensure that we cover in any sort of scenario. So Chapter 11, the emergence from bankruptcy would be that trigger. Chapter 7 would be not just the dissolution, but when the estate itself actually closes. So slightly different iterations of language that need to be determined and really ironed out and be very clear with underwriters amidst this process. 363 sale could be a combination of things, right? A sale of assets, or it could be in conjunction with the Chapter 11. So really just being keyed in on those factors as a broker and helping arrange this alongside my clients. All right, so moving on from those, the grand finale are a few things that keep me from sleeping at night associated with bankruptcy. The first one is that we recommend that clients pay for pre-petition runoff. So they take this big chunk of money, it's usually a multiple of their annual premium, and they shoot it over to their broker prior to filing for bankruptcy. This is important because you want to avoid hang-ups in the bankruptcy court. You can get approval from the bankruptcy court to purchase D&O, but not necessarily runoff. So you definitely want to get that done prior to, and it could be a big chunk of money. In my example, it was a very large sum of money that they had to pay in advance. They weren't even sure they were 100% filing for bankruptcy yet, but they sent the money over. We want to avoid any clawback of that runoff premium in this scenario. And we want to make sure that the endorsement for that runoff has the appropriate triggers that we just discussed, is fully earned, meaning you can't get any money back, and it's a non-cancelable policy going forward. So it's ironclad. There's no way that these individual directors or officers would be left without any D&O insurance. In that scenario, I've been asked before, what if they pay the runoff premium and then they don't go bankrupt? And to that I say, think about a Sonoma County wine country forest fire. You see a fire happening at the next vineyard down, so you decide you're going to buy property insurance, whatever you need to have, and the wind changes direction, it never comes to you. You can't go back to your insurer and say, hey, the fire didn't hit me, give me my money back, right? So in those scenarios, we do try, I mean, of course, big sums of money that aren't actually applied toward runoff. We try to apply appropriate triggers whereby we could either get the money back potentially or apply it toward ongoing D&O insurance, applying toward the renewal. But it is, I mean, it can be a gamble at times, but a worthwhile gamble. The second thing that keeps me up at night in these scenarios is premium financing. I always advise, I never advise any clients to premium finance their directors and officers insurance policy, because when they need it most in a bankruptcy scenario, if they stop paying their bills, then that policy is going to go away. There is, the finance company is still able to cancel the policy in those scenarios. So I try to avoid that at all costs. It doesn't always happen. I have one right now, a company that's just on the ropes. I'm very concerned, and they chose to premium finance their policy. So we really had to walk through in great detail. Here are the pros and cons of this, and here's what the implications could be if you do file for bankruptcy in this policy term. That really covers my D&O piece. I'll touch briefly on, this doesn't keep me up at night. I'll touch briefly on the employment practices and fiduciary before I wrap up here. These are more flexible policies. The employment practices policy, especially in a Chapter 11 scenario, right? When you still have employees doing their job on a daily basis and they emerge from bankruptcy, you know, with the same management team, with the same general policies and procedures and controls in place with related to human resources, there's a chance we can keep that policy in place or not, or we could, you know, there's no real, there's more flexibility, we want the policy enforced during bankruptcy. We potentially could waive a change in control. We potentially could put a new policy in place. Much more flexibility, less concern. Same with fiduciary liability. That's covering the fiduciaries of the retirement plan. That's not triggered until the plans are either terminated or merged into another plan. So that could be way down the road from the filing or emergence from a bankruptcy scenario. And with that, I mean, those are all of my prepared remarks, but if there's any questions, happy to answer them. Happy to send a cheat sheet too, if that helps. I know I just talked through a lot of info.
Thank you, Miranda. This is great. And it really speaks to, I think, a consistent theme that we're going to hear from all the panelists here is we want our clients to talk to us sooner rather than later. In all these situations, you have the ability to kind of position yourself and your clients in a way that will do a much better job of, you know, getting the right outcome and minimizing your potential exposures. It's going to be true for what Ann says and what Julia says, as well as what Miranda said. And I really appreciate your comments. And you hear this and you're like, oh boy, we do need to talk to our clients about this right away. And to everyone who's listening, please let me know if we want to get a cheat sheet from Miranda. We'll be happy to send that out. In interest of time, I would like Ann Parkin to give her story. Now, Ann is coming from a very different perspective, but I think it's going to be as relevant as what Miranda discussed as well with respect to property. So Ann, please take it away.
Thanks, Julia. So basically, you know, my background being specifically property risk control and how we get involved when it comes to specifically kind of any type of acquisition deal. The story that I'm going to tell is where we had a large PE client that was acquiring a food manufacturing operation. Now, kind of over the course of the past probably 2 decades, insurers have moved in and out of various different types of occupancy risk, depending on their loss history. So a while ago, food manufacturing and specifically protein, you know, any type of meat, eggs, dairy was a type of industry that quite a few insurers were having lots of losses in, and just decided that was an area they didn't want to work in. So what was happening was they were non-renewing these type of clients. This PE ended up buying a food manufacturing operation, closed on the deal, everything went well, they were very happy. The way they normally worked was they kept the insurance with the company they acquired. They didn't put it all in together into one large portfolio. So the deal closed, everyone was happy. However, when the renewal came about, they were non-renewed. So how did that impact the kind of the PE firm, the operations? Well, what happened, obviously, when anyone is non-renewed, it's a very difficult situation. The issue here was that the PE firm didn't do kind of insurance due diligence, as I would call it. A lot of PE firms will actually look at kind of the business, the profit and loss accounts, say, okay, they've got insurance in place, this is what the premium was. They may not get into the nitty-gritty of the actual operations and some of the risks involved in this operation. Now, some of the risks that can be involved when it comes to food, it's a probably medium to high risk operations. You have quite often refrigeration, ammonia and explosions. What can then happen is the construction of the building can be a combustible type of construction. So this client actually had what's called insulated metal panels, which are really easy to build and install, but they've got these nasty foam cores that when they catch fire, the smoke that comes off is very nasty and toxic, and fire departments don't actually want to go in and tackle the building. Then their response is, as long as the people are out, we're just going to let it burn. So that was a couple of the issues that they had. This client had also had some unfavorable loss history. They'd had a couple of fires, and they'd also had one natural catastrophe issue as well. So it wasn't a great risk. So once they were non-reviewed by their incumbent, the PE just decided they were going to add it to their portfolio. But because of the issues that I mentioned earlier, their existing carrier didn't want to take on the risk. So, of course, then that becomes a very significant issue that the incumbent won't take it, their carrier won't take it. So they had to go to the E&S marketplace. Now, the challenge with that is that it's kind of, in a way, I like to think of it as a little bit of the wild, wild west market. You can generally get insurance, but you've got significantly higher premium and your terms and conditions may not be as good. But this client needed to have insurance. So as a result of going to the market, the PE firm was advised by their broker that they had to get some engineering inspections done, try and find out what the risks were at these locations. And they had to do it and then look to put together a program as to how they were going to improve these facilities. So they went and had insurance inspections carried out, had a number of recommendations that the risk control engineers said they would need to make, they would need to invest in. So as a result, the PE firm had to spend a lot more money on these assets than they planned to. And they had to hold on to these assets for a lot longer than they normally would have done, basically because of these unexpected costs of the improvements. They did have a lot better assets that they were able to get some more money from. However, they didn't really they weren't the sort of firm that would invest in their acquisitions. They will invest in them, keep them a couple of years, and then sell them on. So it wasn't really a good risk for them to be involved with. I would love to say it changed their behavior going forward, that when they did have new acquisitions, they engaged their broker, they engaged risk control. However, that actually didn't happen. So generally what we like to do when we have a kind of the perfect client, perfect PE client that we want to work with, right from the get-go, get the broker involved in understanding what the risk is. The broker's obviously aware of where there are issues related to that risk. If they'd have got their broker involved at the start, their broker could have said, listen, protein's a really challenging risk right now. Let's do a little bit of kind of insurance due diligence. Let's have a look at the risk. Let's maybe send out some engineers. Let's really get an understanding of what's involved. If the broker had been involved, they could have got the risk control surveys done earlier, which would have led them to know that there was going to have to be a significant investment that they would have needed to have made. And then it could have alerted them to what really, is this an investment we want to make? Is this now the business we want to be in? So it really would have helped them get a good understanding of, if the asset was insurable, or what they needed to do to meet their current insurers requirements. Now, interestingly, FM Global, who's kind of a large property insurer, they will do this for policyholders. If a client will say, we're looking at making this acquisition, they will send one of their engineers out. Now, I started my career in insurance at FM Global, so we would go and do due diligence visits for our clients. And as an FM engineer, it's a great thing to do, really exciting. However, one thing to be aware of, if your insurer does this visit, that information is owned by the insurer, not by you, and you do not have the ability to decide what to do with that information. So anytime an insurer is offering you, hey, we'll do this for you for no cost, there always is a cost. It's always best to have the information yourself and decide what you want to do with it. Do you want to present this to the markets? Do you want them to be aware of the risks? Do you want to give them a little bit of information and move forward with kind of the policy, with maybe paying a little bit more, but keeping that information? Because to kind of Miranda's point about kind of gossip in the marketplace, everybody is aware, and the more insurers that get your information, the more kind of gossip there is, the more we don't want to be on this risk. Even when you've made the improvements, it can be a lot harder to actually get the insurance when you've gone out to a lot of markets. So I think kind of from my perspective and things, that the good experiences that we've had in the past would be when the broker has been engaged early, and the broker engages risk control early at the start to say, listen, we need to send somebody out. And obviously, given the way the market is right now, and insurers wanting all of this information and wanting this risk control data, risk control is kind of a very time-sensitive issue right now. I think every single company that provides this service is incredibly busy. So kind of start early. I think kind of when you're having your annual renewal, talk to your broker about, these are the things we're thinking about investing in, and look at your broker as your partner, not as just somebody that helps you with your renewal every year. They really need to be involved right from the start. They can really provide you with great information. And I think a lot of PE firms don't work that way, but when you do work with that way and partner incredibly closely with your broker, you can really see the true value that that's going to bring to you, and that's going to bring to the process moving forward. I found that, you know, when you do partner together, it's so much more beneficial. It really is. It's a lot more of a process, a partnership, and you can offer a lot more advice that can really help. So Julia, you're absolutely right on. It would have helped with pricing negotiations too, because it really can help so much. And having an engineer involved in all of this, really, you know, even having the engineer sitting in a kind of your renewal strategy meeting or your renewal meeting with your insurers does make a huge difference. To actually have an engineer that speaks insurance as opposed to just engineering, and understand and help the underwriters understand why they need to be on that program, and also kind of vouch for the client and what they're looking to do and what they're looking to invest in, so that the underwriter can really see the true benefits of being with this firm. Julia.
Those are great. Yes, thank you, Anne. Those are great comments. And I think one of the things you alluded to is in this day and age, the property market is really, really tight. You know, with all the cat exposures and all that sort of exciting stuff, there are a whole host of reasons that insurance carriers want to get off stuff. But on the other hand, if they work with folks like you to really in advance, they're actually negotiating a true good price for the purchase or sale, and to show sort of their intent on this stuff, it really does make a huge difference in your ability to successfully navigate a very, very difficult market at this point in time.
I would totally agree with that. And I think as well, underwriters like to see that people are invested in improving their risk, not just getting the risk control report just because they have to. So yeah, true partnership is the way forward.
For sure, for sure. Well, thank you so much. And I think those who are listening can hear that, you know, preparation and us and the worrywarts who are in insurance bring value to the table, right? If you think about these things well in advance, you can pivot, you can negotiate, you can collaborate to get the best outcome for your clients. And with that, Julia, I'd like you to jump in on sort of how you can affect these types of transactions and what you can do to move them along.
Thank you, Julia. I'm going to take a quick step back and give a little context at the risk of being a little bit rudimentary for those who are already aware, but just what are we talking about with representations and warranties insurance? So at a basic level, in any kind of sale, you've got sellers making representations and warranties to the buyer about the state of the company that they're selling. And usually and traditionally, without this insurance, the seller is required to put up a certain amount of escrow so that if something goes wrong, the buyer can claw back from that amount and recover if there was a breach of really anything. And it's really all of the reps that are being made that go to things like the financial statements, employee benefits, tax, intellectual property. So it's really everything about the health of that company. So where does it come up in a distressed sale context where you've got, you're on shakier ground with the company that's being sold? The story I'm going to tell is about an oil field services business that we worked with. So they were distressed and they wanted to find potential buyers. So they opened up the market to buyer bidders before we were involved. And they tried to sell their assets on an as-is, whereas basis, which is basically legal jargon for saying clean exit for the seller, walk away, no indemnity. And buyers, we found they actually identified a couple of energy focused companies or private equity firms that were focused on energy. But the couple that were interested were not really comfortable with the no recourse structure because they were concerned that they would uncover issues post closing that would devalue the assets. So the seller actually reluctantly agreed to provide some sort of indemnification, but that ended up being effectively meaningless because they were insolvent and they were no longer really a credit-worthy counterparty. So there wasn't that much other than the actual assets that they could offer up as reassurance. So something important to mention, I mean, what I'm talking about applies whether you're in a bankruptcy sort of 363 sale situation or even before you get to that stage. Or even in a healthy company, situation. So it kind of is applicable in sort of any kind of M&A transaction. But you might ask, well, in a bankruptcy, wouldn't the buyers be protected from certain ongoing liabilities that get extinguished in that process? And free and clear orders do not overcome certain risks that the buyer will have to inherit. So some of those could be things like compliance with laws, condition of the assets that they're buying, financial statements breaches, tax representations, intellectual property. That one comes up a lot if there are issues with the IP that's being acquired. And importantly, in this example, a lot of times environmental liabilities would not be extinguished. So how does rep and warranty insurance come into play? So you can actually cover off these pre-closing risks with a policy if the insurers are able to access the diligence that the buyer is performing and underwrite the risk. They are willing to step into the shoes of the seller for purposes of the indemnification in the agreement. And they will put up whatever amount, usually it's 10% of the enterprise value at risk. And they will pay for any breaches that were unknown to the buyer at the time of the sale. So what happens and what we saw happen here was that the buyers got a lot more comfortable because then, they had recourse if something went wrong with this business. And so I'll just sort of sidebar in a bankruptcy proceeding specifically. We've also worked with companies in a pre-stalking horse bid kind of situation. So if there are multiple bidders in that scenario, you can actually enhance that you'll be the probability that you'll be selected as a buyer because you have more closing certainty. So we've worked with certain buyer bidders in that scenario to actually have the policy effectively underwritten and ready to bind at the time that they're granted that certainty that they'll be the bidder in that 363 sale to go forward. A couple of points about the insurance itself and how it works and what the process is like. So It's a two-stage process. We basically, go out and get quotes on behalf of the buyer. We typically are talking about working on behalf of the buyer. The seller can be the one who kind of pushes for the policy, but the buyer is ultimately the one who's going to be living with the policy and the insured under the policy because they're inheriting the company itself. So if something goes wrong, they're the ones making the claim. The seller can pay for the policy. That's not an issue. The insurers don't care about that. And the seller can even pay the deductible under the policy. That's also often something that comes into play just as a function of negotiations and sort of, who's willing to do what. So in the quote stage, we really don't need that much information to go out and kind of explore this idea. We really just need a SIM or a management presentation describing the target company, as well as the financials and an early stage purchase agreement. And with that, we can go out to the insurance market and request, effectively quotes that will get you a very good idea of what the coverage will look like, any high level exclusions and pricing, retentions or deductibles, et cetera. So that's usually about 3 or 4 business days. And then for the actual underwriting, it's very fast. We have, in this realm of rep and warranty insurers in North America, a lot of us are like me, former M&A attorneys, kind of working around the clock to just make sure that we meet transaction timelines. And so as all of the M&A professionals know out there, it really is kind of an intense process. But what happens is we try to marry the coverage and the actual binding of the policy with the signing and closing of the deal, so that there's coverage on day one.
Yeah. I'd like to interrupt you. We do have a question from Jeff Wright. I don't know if you can open it up. Can you see it? If not, I'll read it out.
If you don't mind reading it, that would be great. I don't see it. Thank you.
This is a question. I'm working with a startup company who uses a third-party contract manufacturer and suppliers. What sort of agreements and language in an insurance policy is necessary to protect the interests of the board and officers and hold them harmless for any products liability claims? And what are the costs for such a policy?
I mean, I think in that question, there's probably 2 policies at play. So there's sort of like a D&O, a directors and officers liability sort of policy, but then separately, you can have a rep and warranty insurance policy that would cover off risks for any issues with product liability. So you can have a rep that buyer's diligence to make sure there's no history of claims and there's been no issues, where they look very specifically at the warranty that's offered on the product, and they make sure that there's a clean history there, and they can get comfortable with that typically and cover that as part of the very broad suite of reps that they're covering in a rep and warranty insurance policy. So you kind of got two avenues there. Hopefully that helps address the question. Another thing to mention in terms of features of these policies that are really better than what you would get from any kind of seller is that they last for 3 years following closing for all reps. So that gives the buyers a pretty substantial amount of time to uncover any issues. Often we were seeing in terms of the claims that most things were coming up in the first 12 months, really one audit cycle. But what we've observed in the last couple of years is that there's a little even more of a lag. And so your traditional indemnity of 12 months or 18 months from a seller wouldn't cover you in the way that these policies do, where they actually can reach out even further if something comes up. It used to be the case that financial statements breaches were the #1 area of breach. That's now been eclipsed by compliance with laws breaches. That just may be interesting for people to look at. I would also point you to our claims study that is very comprehensive, and whether you're using rep and warranty insurance in your transaction or not, it's just a helpful indicator of where we actually see problems come up, because everyone thinks, even in a distress situation, everyone thinks they've got a clean deal. Everyone thinks that we've done all the good diligence, we've hired good advisors. And we truly, I mean, looking at the claims that we see, the claims come up in, it's true, it's for the unknown. That's what insurance is for. And so the risks and the things that where we've seen breaches have been for things that people truly were not aware of before they signed the deal. And I should mention that tax and fundamental reps are even covered for even longer. They're covered for 6 years post-closing. So some really great solutions. I would echo what Miranda and Anne have said. Make us part of the conversation early on. I mean, you don't have to have everything tied up in a bow when you come to us. We can explore and talk about different solutions. I mean, this provided a very tidy solution for the seller, and we actually worked with a buyer that was quite happy to have some recourse against a seller that was otherwise insolvent. So I'll conclude there. Thanks, Julia.
Thank you. And then Miranda, the question that I posed to Julia, could you speak to a little bit to the D&O aspect of the startup and those protections?
Yes. So the D&O policies, I mentioned this kind of vaguely. D&O policies are financial loss policies, which means they have big fat exclusions for bodily injury and property damage. So a product's liability claim would not be a claim covered under a D&O policy. However, an allegation of negligence or malpractice against the directors or officers or board of directors or management team could be in some way covered by a D&O policy as well. So, I mean, and of course, there are separate product liability policies that can be purchased on their own too. And I can't really speak to that, but from my perspective, there is certainly coverage for financial loss only should a director or officer be named in a suit. There may be some elements of coverage that are not covered and some that are, but that's an argument for allocation that we can make.
Thank you. So just to circle back, we've talked about just a huge number of things, and I hope those who are listening understand or have a sense of what the insurance aspect of these transactions can be. And in an ideal world, as Anne was saying, when we're bringing everyone together and collaborating early, we can really do some amazing things to protect our clients, to make the deal happen, to get out of the deal if we need to get out of the deal, and to get it priced right and all those things. So basically my goal here, and I hope that I've achieved it, I think I have, is for our listeners to understand what insurance is to these types of transactions and how if you work with good brokers, you're going to have much better outcomes. And I think I'm going to talk a little bit, I'm going to tout some of the firms that are here, right? We have Aon, Sigma 7 is a risk advisory, Gallagher, and these larger brokers are much more involved in these types of transactions. And what I have seen in my past lives, and maybe the panelists can talk to this, is we have clients who get all excited about buying a whole bunch of little things, and they're buying them, and the agent on the other side is like, well, they told me X. And they take it at face value. And then you get to what Anne was talking about, which is, oh, well, by the way, we're going to be non-renewed. And so when you have a less sophisticated insurance broker involved in the transaction, it can get really, really challenging. So it's worthwhile to talk to your clients, to get them involved, and to make sure that their broker or agent understand exactly what we're trying to do here. That's I had that experience repeatedly in the past couple of years, tied to property, tied to private equity, buying lots of little properties and thinking they were getting great deals, and they really weren't. So are there any other comments or anything that the panelists or anyone who's listening would like to raise or ask or say? I think we're done. Thank you so much to my panelists. I'm just so thrilled that you were able to take the time to do this. What you bring to the table and your understanding of these transactions is fascinating. I think that you are obviously, your clients are very fortunate to have you. And I'm hoping that those who are listening and involved in this webinar have learned something today. And please feel free to reach out to me or Amanda, and we will make sure that we get this information or your questions to Julia, Anne, or Miranda. So